Crop insurance deadlines are approaching for the 2016 crop year. For the 2016 year, cotton producers have many options for crop insurance. Some of the newer choices are STAX, SCO, Yield Exclusion, and the Cottonseed Endorsement. STAX and SCO both cover area-wide revenue losses. STAX is a crop insurance product for upland cotton that provides coverage for a portion of the expected revenue for an area. Most often the area would be one county, but it may include other counties to obtain enough data to establish an expected yield and premium rate. STAX payments are determined only by area revenue and are not affected by whether a grower receives a payment on their individual policy. It is possible for a grower to experience an individual loss on an individual policy, but not trigger an area-based STAX payment. The average cost of STAX is about $8 per acre. The cost varies by practice and region. The National Cotton Council worked with RMA to bring some additional enhancements to STAX for the 2016 crop year. Producers now have the option to make separate STAX decisions for irrigated and non-irrigated land. For example, a producer may only want STAX on non-irrigated land. The producer would purchase a STAX policy on non-irrigated cotton, maybe a 90 to 70% policy, and would get a 70 to 70% policy on irrigated, which is a zero coverage policy with no premium. Producers also have the option to add the Cottonseed Endorsement to the STAX policy. This would cost about an additional $1 or so, and that would be added to the STAX policy. Another change in 2016 is that some STAX areas have been redrawn. Producers can check with their insurance agent to determine their STAX coverage area for 2016. Yield exclusion is another option available for the 2016 crop year. While some producers did take this option in 2015, others chose not to take it. Some may not have taken it due to the increased premium associated with yield exclusion. However, it is important to remember that many options are available with yield exclusion. The most effective and affordable risk management package for each producer may include a combination of individual revenue protection, yield exclusion, and possibly an area plan. So it is very important to analyze the options together. Producers do not have to exclude all available years from their APH history, and it is unlikely that the optimal choice would exclude all years, particularly in the Southwest where producers can exclude many years from their database. In some years, the producer may have a good yield even though the county yield was low and the year was eligible for yield exclusion. In addition, taking yield exclusion and keeping the same coverage level would likely result in a higher premium. Producers may be able to take yield exclusion, get a higher APH, and then lower the coverage level on their individual policy, which would lower the premium. In many cases, producers could do this and still have the same coverage level as before due to a higher APH yield. Combining yield exclusion with STAX or SCO results in many new options, and it is important to producers to work with their agent to determine the best risk management option for their operation. Crop insurance is extremely important for U.S. cotton producers. However, crop insurance does not provide adequate protection for multi-year price declines. In addition, it does not adequately compensate producers for quality losses. In 2015, cotton acreage was down about 20%, thus the lowest area we've had in the United States since 1983. As a result, we're seeing a reduction in the number of gins and cotton warehouses, and the ripple effect of declining cotton production can be felt in rural economies throughout the 17 cotton-producing states. A major issue is the lower price coupled with higher production costs. If input prices were the same as 5 or 10 years ago, producers would not be under financial distress. Prices are currently 20 to 20% lower than in 2013, but production costs have continued to increase. Average crop returns are not meeting the cost of production unless a producer has above average yields. Along with low prices, several other macroeconomic issues are affecting the cotton industry. The U.S. cotton industry relies heavily on export markets, and this year exports are down significantly due to lower exports to China, the strength of the U.S. dollar, the Turkey anti-dumping investigation, competition from India, and competition for man-made fibers. Support for cotton under Title I programs was eliminated in the 2014 Farm Bill due to the WTO Brazil case. This led to more reliance on risk management programs, and new products were established to improve risk management coverage, such as STAX and yield exclusion. However, crop insurance products were never designed to cover the type of losses currently facing cotton producers. Low futures prices also limit the coverage of crop insurance products. However, we are currently in a much different situation than we were when the Farm Bill debate began. Prices are much lower in part due to policies in China. The U.S. is faced with increased competition from other major cotton-producing countries, such as India, that have continued to increase support for cotton production. Chinese policies continue to affect the world cotton market as record stocks still hang over the market. In recent years, China built a government reserve of 50 to 60 million bales of cotton. This huge stockpile has created great uncertainty in the market. Cotton's situation is unique among commodities because we have been hit with significant changes in both market prices and the farm program safety net. Cotton producers are operating under a safety net that was never designed for these dire circumstances. China and India, the only two countries producing more cotton than the United States, are operating with support from their own governments. This makes it difficult for U.S. farmers to compete in a global economy. Since China and India are considered developing countries under the WTO, they are granted more latitude in terms of support that might otherwise be deemed unfair in a developed nation such as the United States. If raising cotton no longer pencils out, equipment is one factor farmers must consider. Most producers have difficulty justifying leaving a $650,000 cotton picker sitting in the shed as they shift to another crop. And selling a picker with so many leaving the cotton business becomes a difficult task. Farmers who irrigate in drier regions might also struggle to find another crop that can use water as efficiently and handle drought as well as cotton. The real threat at this point is a loss in infrastructure as more producers stop planting cotton. This will result in severe financial stress on rural economies as they depend on the direct and indirect economic activity from cotton production that extends far beyond the farm gate.